Don't trade zero DTE options blindly. There are 7 types of market days that offer ideal zero DTE options trades, and in this video, we'll teach you how to spot the different types of days and which zero DTE option strategies to trade with them. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from 2 professional traders on our desk so you can grow your trading account.
Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And with the explosion of zero DTE options over the last few years, you can only imagine the number of questions we get from traders about the best way to trade zero DTE options and what clues the market is giving us as to what's really going on in the market, and more importantly, where the market is likely to go during the day. And so Garrett Drinan and I have teamed up to present to our YouTube family a 4-part series on how to use technical indicators to trade zero DTE options. So this is the 3rd video in our series, and we got some pretty fascinating examples in this video to share with you. So you're going to want to stick around to see how we address the market based on market signals related to market breadth, which is a measure of basically how many stocks and industries are participating in a particular rally or a sell-off. And that's important because if most stocks and industries are represented in a big market move, that tells us one thing. And if only a few stocks are driving a big market move and most of the stocks and industries are actually going in the opposite direction, that tells us something also. And in fact, there are 7 distinct kinds of market breadth days, and our expert Garrett is going to fill you in on those shortly. Before we get into this more deeply, if you're absolutely brand new to options trading and you don't know much about options or how they work, we've created a video for you to understand options basics. And if you click the video appearing now on your screen, it will lay the groundwork for you to understand the option strategies that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so with that said, Garrett, can you explain to us exactly what market breadth is and how it can inform our picture of where the market is likely to go on a particular day?
Yeah, so there's a few different metrics that we look at in terms of market breadth. And if you haven't seen the first installment of this series that we've done, we cover it in that video. So we could link that down below if you want to check it out in more detail. But in short, we look at things like the Vold ratio, which tells us about the volume flowing into the up stocks relative to the volume flowing into the down stocks. We look at the advanced decline line, which tells us the difference between the number of up stocks on that day and down stocks on that day. And we look at the tick, which tells us the difference between the number of stocks on the exchange that are currently trading on an uptick and the stocks that are currently trading on a downtick. Right? So these are our 3 big internals that we watch. And then, of course, in the next video, the second video, if you missed that, we also cover tracking the sector ETFs, because sometimes that's what's driving the market. A lot like we've seen recently, where maybe one sector, like the semiconductors, are driving the market, right? And we want to see, are these offensive sectors like technology and consumer discretionary, or are these defensive sectors like utilities or consumer staples? Because what is leading the market matters as well. So these are the things that we're looking at. And today we'll go over various types of breadth days, because there are different ways that all of this can unfold. Because I think it's really important to point out that we're looking at all of this as a whole and how they work together. We're not just looking at one thing. We're not just looking at the Vold alone. We're not looking at any of these things by themselves, because at any given time, price can be going against any of our signals, right? Because in trading, as we know, nothing works 100% of the time. But also, if we're just kind of keyed in on one thing and missing the big picture, we might not actually get a feel for what's going on in the market. So let's just cover 7 different breadth type days just to kind of go over the different ways this can play out. So first, we have a day that I like to call the breadth extreme. Now, this is a day that we actually covered in our first video. We focused on these days, right? So many of you might actually be familiar with this type of day. I like to start here because it's a very clear type of day. And they often happen with gap and goes, because with big gaps, we often open with very extreme breadth. And on these types of days, we want to see all three of those things give us extreme readings that hold. That's the general idea. And specifically, we want to see a really high Vold ratio, right? And that right off the bat. And in this day, this is a bullish day, of course. So we're going to see a very extreme positive reading in the Vold. On a bearish day, it would be an extreme negative reading. And then this is really important. We want to see the advanced decline pinned to positive 2,000 in this case. And we can see that below the price bar there. Or on a bearish day, pinned to negative 2,000, okay? And we want to see it just stick there all morning, right? All morning, all afternoon, until the close. And then we also want to see the tick holding above or below zero. And again, these are things we covered in that first video because a lot of our examples were this type of day. Now, this is a great day to trade because you can get these signals early. I like to look for this type of trade when we get a gap, especially on a catalyst, because these are the indicators that I look at to see if we're going to get a trend day. And of course, I also want to see the offensive sectors leading on this kind of day. Okay, so in this case, we're just looking at the breadth, and all of these things are aligned nicely. Now, let's just take a look at what happens on a different type of day where the advanced decline does not pin to that positive 2,000, right? And I call this a breadth reversion day. Okay, so this is a gap down, right? So we'll have to flip our logic a little bit, right? On this type of day, we have to expect that the internals are going to open fairly bearish because we have a gap down. And they do in this case, okay? We get a fairly bearish Vold at the open, and we get an advanced decline that opens very negative, right? And in this case, just like in our last example, if we're going to see follow through to the downside, what I'm looking for is for that advanced decline to pin to negative 2,000 in this case, right? So that line that's below price on the right side of the chart, below the volume bars, is the advanced decline. And you can see that it rallied right at the open, right? So right away, we could see that it was not pinning to negative 2,000. Okay, so now we don't have an extreme breadth day, right? We still might see the Vold is very negative right now, right? And we don't want to get tricked by that. We don't want to get too sucked into just watching the Vold ratio because the advanced decline is telling us that we're not getting that setup. So often on these types of days, when the advanced decline rallies like that right at the opening, goes right back to zero, like fairly quickly on a gap down, we're going to get a reversion to the mean. So what I might look for is for price to close the gap, right? And that in this case, that's what happened. I don't always trade these types of days because the moves tend to not be as powerful. But even if I'm not trading it, this is what's telling me not to short the market, which I think in my case sometimes is like even more important because I'm looking for follow through a lot of the time. And so when I see the advanced decline do something like that, I'm thinking, okay, the odds that we're going to follow through to the downside now are much lower. All right, so let's check out the next slide. So this is a day that I call the breadth crescendo. And a lot of trend days happen in this way. Most of our trend days are going to happen in this way. And, I like to teach that breadth extreme first because it's my favorite. It's very clear. You can tell super early the odds of a trend day, right? Because everything is starting out so extreme and you're just watching things hold. This day is a lot more subtle. Often we don't get a gap or we get a small gap, like in this case. And what happens is the Vold ratio and the advanced decline are just going to be climbing all day, right? So we start off with fairly neutral, maybe slightly bullish, but fairly neutral readings, like nothing that's going to really get your attention and say, hey, I think, this is going to be a trend day. Let's just get long at 9:30, right? But as the morning goes on, you just see that breadth is climbing and climbing and climbing. And on these days, what we'll usually see is that by midday, the breadth now is at a breadth extreme. And it's going to continue to climb into the close. And the cue to see this type of day develop is by looking at the tick. So the chart on the left has the tick below price, okay? And that's what I like to see on this kind of day, hold zero. It's going to hold zero all day. It's going to hold above zero. And what that's doing is that tick sustaining above zero is allowing the advanced decline to rally and that Vold ratio to rally and continue to do so all day. So we just get this crescendo in the breadth. So this is a day that I call the biased range day. It can be a tricky day, right? This is a messy day. But what I like about it is that when this is happening and I can identify this, it can really inform me as to what to expect out of the price action. So we get a gap down, like a pretty decent one, and the breadth opens fairly negative. And it stays fairly negative all day. It's a very negative Vold ratio, right? The advanced decline is negative. It's not pinned to negative 2,000, but we're getting negative advanced decline readings all day. So we're in a bearish breadth environment. But if you look at the tick is above and below zero, right? It's fairly volatile. It's kind of a mess, right? So again, if we kind of look at what we were looking for that breadth extreme day, we're not getting it in the tick. And so what often will happen on a day like this is that price will just hold lower and we get a range that holds lower. And so the only trades that I see for myself on these types of days, and I can, the most I can ask for myself is that I'm not just playing for continuation to the downside, right? Because you're just going to get chopped up, especially if you're shorting lows. But if you notice the tick, you might notice that there are big spikes in the tick throughout the day. And those spikes correspond to price rallying into resistance. We see it 3 times. And we can kind of see that resistance level, 1, 2, 3, throughout the day where price just got knocked back down, back to the bottom of the range. And so if I can identify this kind of day, and I do want to trade it, I am looking for those extreme positive ticks because we're in a negative breadth environment to fade back down to the bottom of the range. It's still not an easy trade. It's not something I'm like jumping up and down about and like trying to do all the time. But again, it gives me the context of, okay, I think we're having a biased range day. I'm not expecting follow through to the downside. The tick is very messy, but I don't think we're necessarily just going to rally and reclaim yesterday's levels. I think we might stay heavy. So any sort of rally back into resistance might be fadeable. So this is a day that I call the breadth divergence. And I actually really love this trade. I took this trade on this day, which is why I put it in here. And sometimes this can really catch you off guard. So again, we get a gap down on this day. And like I said before, when we get a gap down, we're often going to expect the breadth to open fairly negative, right? Because most stocks should be down if the whole market gapped down. And this is a pretty sizable gap down. So if you notice, the Vold ratio at the open on this day was slightly positive. I mean, it was fairly neutral, but even in positive territory. And that's alarming. Like that usually doesn't happen, and it's pretty unusual. So that's going to get my attention. And we can see that the advanced decline just kind of like reverts back to zero, and the breadth is really not that bad. So it's kind of like, it's that moment of like, okay, like what's the market doing down here? Okay. And on this kind of day, I do want to shift my attention to the ETF filter that we covered in the second video, right? Because it is possible for the market to sell off against slightly positive breadth, right? That can happen. So what I want to see also is that the offensive sectors like our technology and our consumer discretionary are not leading the market to the downside at the open, right? On that gap, I want to see that actually the technology stocks and the consumer discretionary stocks, and in this market, I might be looking at semiconductors because they're the ones driving the market. I want to see those be the strongest off the open, and I want to see the staples and utilities and maybe healthcare the weakest off the open. And that's just going to give me that extra color to say, okay, like I think that we're probably not going to fall through the downside, and we might be able to play for a reversion back to the mean. So again, maybe it closes the gap, which it did here, and maybe it trades back to 2-day VWAP, which it did here. And those are kind of my targets, and I'm not looking for a trend day. I'm not looking for an all-day move. And if we happen to get to 2-day VWAP and I'm still in, which would be, an amazing hold, like I'm definitely out by then, because I really don't expect this day to be some big event. It's just that when we open that low and the breadth isn't that bad and technology might be leading to the upside, I'm just thinking to myself, okay, we might need to just revert for a second. So let's check out the next slide. All right, so this is a breadth neutral day. This is one of the most common days. We get this all the time. And of course, right, because the market usually kind of does nothing most of the time. And in some markets, there's high volatility and we get less of this. But in normal markets, we get a lot of ranges. And a lot of days just have completely neutral breadth, right? That's advanced decline between positive 500 and negative 500, so somewhere in the middle, like nothing extreme. It's a Vold ratio that's less than positive 2 and higher than negative 2, so again, somewhere in the middle. And it's a tick that's above and below 0, and we're just getting kind of benign signals everywhere. And you can see how on this day, we open a little bit higher, and we get slightly positive to neutral breadth at the open, but nothing crazy. And right away, you see the advanced decline just sucks back to 0. The breadth sucks back to 1. And there's nothing special about the tick. And the advanced decline just kind of pins to 0 all day. And so with this kind of day, I'm just kind of expecting price to balance around some area, some range. And in this case, we kind of balance around where we did most of the volume on the previous day. And it doesn't mean that we can't get a down move in the market during this kind of breadth. It doesn't mean we can't get an up move. Like right here, you see that we got a down move right at the open. But what I do like to see often on this kind of day is that by the time the day is over, we kind of look back and see, okay, we pretty much balanced and stayed in a range when it's all said and done, and we probably close somewhere in the middle. And if you happen to trade market neutral strategies, this is something that is really good to see when you're doing that, because it sort of negates a lot of those extreme type continuation moves that can happen in the market. And often what we get is something that's pretty subdued. And so if you're trying to do market neutral, it can be like a fantastic signal for that kind of thing.
Well, Garrett, I got to tell you, great minds think alike, because I want to stop you right there, because what you're saying about neutral breadth days is really significant, as you're saying, to options traders, because unlike pretty much any other style of trading, options trading has this incredible flexibility, which can adapt beautifully to whatever the market is throwing at us. You see, with most other trading styles, you need the market to move to make any money going long or short of stock, say. But with options trading, there's a whole discipline of options trading centering around taking advantage of when the market doesn't move, which you just said is most of the time. And this is known as options income trading, which is an important discipline here for us at SMB. And so when you tell me the market breadth on a particular day is neutral, that tells me it's going to be a good day to seriously consider putting on one of those trades that we were just talking about, which prosper when the market doesn't move. So let's get into an example of how that would have played out on the day you're discussing here, showing market breadth neutrality, which was January 12, 2024. And as you can see, the SPX index, from which the stock SPY, of course, is derived, was trading at 4776.54 at 11 a.m. And so once we've established that this is shaping up to be a neutral breadth day, then we can turn to an options trade, which actually makes the greatest profit on the days where the market doesn't move much. And so let's say we pull up a 0 DTE options chain and find a call with a strike price about 20 points above where SPX is trading up at the 47.95 call. And we sell 5 of those for 265 and then move down about 20 points below where the index is trading, down at 47.55, and we sell 5 of those puts for 235. And then simultaneously, for protection, we move 10 points further up on the call side and buy 5 of the 48.05 calls, and we move 10 points below the puts we sold to the 47.45 put, and we buy 5 of those as well. Okay, so when we do this, selling calls and puts and then surrounding them by long calls and puts further from the market, that is the execution of what is known as an iron condor to options income traders. And it's one of the best strategies to use when you feel the market is not going to go anywhere, most likely, and will just trade in a range all day. And so what's important to realize about an iron condor is that it has a significant cash flow implication on your account. And so let's see what happened here from a cash flow standpoint. As you can see, we sold those 5 calls at $47.95 and they were priced at $265. But remember, index options pay off at a rate of $100 per point. So you multiply that by 100 and you sold 5 of them. So the total cash inflow you received from the $47.95 calls was $1,325. And using the same kind of calculation, you bought the 48.05 calls for $565, and you also sold the 47.55 puts for $11.75, but you turn around and buy the 47.45 put for $590. So when you net it all down, you've got initial cash flow into your account of $13.45. Now, your broker is going to require you to have at least $36.55 in your account to execute this trade, incidentally. But if you want to trade it small, you just reduce the lot size and the capital requirement comes down right along with it. Okay, so let's move to the end of that day. And as you can see, the neutral breadth call on that day ended up being accurate. And as you can see, for the rest of the day, the index just channeled in this kind of tight range, closing around 7 points higher than where it was when we opened the iron condor trade, which is nothing for the SPX. Okay, so when a 0 DTE options trade expires, then you can assign a final value to each of the options that comprise that trade, and that's going to be pretty straightforward in this case, as you can see, because starting with the original cash flow of $13.45, let's focus on the $47.95 calls. Well, those expired more than 11 points above where the index closed at $47.83.83. So those expire worthless because they only pay off if the market closes above the strike price. And of course, the long call above that's going to go out worthless as well, obviously. And puts don't pay off at all if the market closes above their strike prices. So both the 47.55 and the 47.45 puts, those expire with no value also, meaning you simply pocket that original $13.45 in cash that you originally received, resulting in a win of over 36% in 5 market hours. And so, Garrett, that's the way an options trader could leverage his knowledge of market breadth on a neutral day for a terrific winning trade. Okay, so let's cover the final kind of breadth day.
All right, so we don't need to trade every market day. We don't need to predict every single market move to make money, right? So nothing works 100% of the time, as we know. And I've been baffled by the market plenty of times, like more times than I can count, right? As every pro trader I know has. Sometimes the breadth might be going against what the market tone and ETF filters are telling us. Sometimes the breadth might be going against what price is doing, and things might be less clear. There are some narrow markets, like the one we've been seeing lately, where the leading sectors in the ETF filter become the key factor driving the market. And then we shift our focus to the ETF filter. But there are also days when everything aligns and things become very clear. And for me, this is when I want to put on risk. And so our trifecta day, which we'll go over now, is an example of this. So this is the trifecta day, and I call it the trifecta day because we have everything, okay? We have the Vold ratio and the advanced decline at an extreme level and pinned, right? So that's the breadth holding at an extreme. So that's one. 2, we have the tick holding, in this case, above 0 the entire day. Could be below 0 for a downtrend day, of course. And then we also have the leading sectors are the offensive sectors in the market. So we're looking at our ETF filter and we're seeing technology. We're seeing, in this market, semiconductors. We're seeing consumer discretionary lead the market higher, right? So we have the tone and a risk-on sentiment telling us that money's being put to work in the right sectors. We have the tick holding above 0, telling us that there's sustained buying pressure in the market, and we're having the extreme readings in the breadth telling us that most stocks are participating in this rally. And so when I say things are lining up, this is exactly what I mean. And we could even add like a fourth one on this day because there was a catalyst. We had I think it was the first cold CPI reading in a market that really depended on that situation, right? So we could call it a quadfecta for that matter. And so we had everything going on this day, right? So there are a lot of days in the breadth where, like I said, it's less clear, and I'm just not going to trade on those days, right? I might just go find a stock that's in play, an earnings play or something else, right? But on this kind of day, I want to trade the market, right? Because I'm really seeing it. And I did trade the market on this day, and I got long. And so this is the kind of day that I think you can probably make your month in. You can at least make your week in it. You can make a record trade because everything's lined up. And of course, nothing works 100% of the time, but when all three of these things are lined up, the odds are so stacked in our favor, right? Especially when we're above all the levels on, we're above yesterday's levels, we're above the weekly levels. Like in this case, we just have everything going for us. And so it just becomes a very clear situation to put on risk to the long side.
Okay, so Garrett, now a trifecta is a pretty strong indication that we got a bullish or a bearish day on our hands. And one of the coolest options trades that you can take on a day where you're feeling just really, really good about the direction of the market, like the market giving us a trifecta, is a trade called the risk reversal. It's an options trade, and you're going to see in a minute why this trade is incredible for trading a trifecta breadth day like November 10th, 2022, the one you were just talking about. And so since the Qs are based on the movements of the NDX index from which it's derived, we can trade this signal on either the Qs or the NDX index. But back in 2022, the Qs options only expired on certain days of the week. So we're going to show you how to trade this example in the NDX index, which is virtually the same as trading in the Qs. And so at 11 a.m. that morning, as you can see, the index was trading at 11,396.14 at 11 a.m. And by then, we had established that this was a trifecta breadth day. And so we go ahead and pull up an options chain of NDX expiring that day, 0 DTE. And we look at the delta column on our broker platform, and we find a call option that's located as close to 30 as possible, which, as you can see, is the 11,460 option. Okay, so we're going to need to cover this in depth in another video, but suffice it to say that an options delta is a prediction of how much that options price is going to move based on how much the index from which that option is derived is moving. And so we go ahead and buy one of those calls, and as you can see, the price is $21.65. So then we move down to the put side, and we find an option with a meaningfully higher price than the one we just bought. And so we select the 11,350 put with a price of 33.25 in this case, and we protect that with a long put down at 11,225, for which we spend $8. Now, let's take a look at the cash flow first of this trade. And starting with the only option that we sold, in this case the 11,350 put, as you can see from the calculation, we brought in $33.25 in cash. But then we turned right around and bought that 11,460 call, which cost us $21.65. And we also bought that protective 11,225 put for $800. And so netting it all down, we end up again with positive cash flow of $360 when initiating the trade. And so right off the bat, $360 is going to get deposited into your account. And be aware that the worst case scenario of the trade is a loss of $12,140. So your broker is going to be requiring at least that much capital in your account at the outset of the trade. Okay, so let's move to the end of this day, because remember, this is a one-day trade whose options expire at the end of the day. And as we can see, the index closed at 11,605.96, up dramatically on the day. And so again, we're in a position now to assign a final value to each of these options, because the options are now expired. So we start out by acknowledging that we got that $360 in cash originally, when we executed the trade. And then starting with the long call up at 11,460, well, the way you value a call if the index closes above the call strike price is to take the closing price, which was 11,605.96, and subtract from that the strike price of the call, which gives you a value of 145.96, which you then have to multiply by 100, remember, because it pays off $100 per point that the index expires above the strike price of the call. And so that option actually pays us $14,596. Then on the put side, well, that short put at 11,350, that expired more than 255 points below the closing price of the index, and puts only pay off if the index closes below the put strike price. So that short put, plus of course the long put below it, they both expire worthless, leaving us with 14,956 in cash in our account for a one-day trade. Now, before we wrap up consideration of this trade, I wanted to point out something really fascinating about this trade, and that is that I'm sure that Garrett would attest to the fact that the trifecta is not exactly guaranteed to work out every single time, right? But it's a very strong indicator, but certainly nothing in the market can be guaranteed. So there will be no doubt occasions where the market doesn't quite act like an indicator would have expected, or maybe it just moves a little less strongly than the indicator might have suggested. And so think about this. The trade originally had positive cash flow of $360. But think about what would have happened if the index had closed, let's say, above the highest put at 11,350, but below the call at 11,460. Well, in that case, then, all three options would have expired worthless, and you could have just walked away with your initial $360 as a kind of a consolation prize for playing the game. And so the fascinating thing is that what that means is that at any price above 11,350, you would have made at least $360, and at any price above the call's location at 11,460, you make the value of the call on top of the 360 you collected up front, which is what happened in this case. So that in turn means that at any price above the highest put location at 11,350, you'll make something on the trade. And if the market, of course, goes parabolic like it did on this day, you'll make a hell of a lot more than that. And so the risk reversal can not only be a very profitable trade, but a very forgiving trade too, where you can be outright wrong on the rest of the market day and you still have a really good shot at making at least some money on the trade. And so what I'd like you to take away from today's video is that market breadth is a powerful way of sizing up the market on any trading day. And when you combine the knowledge of the 7 kinds of market breadth days with the knowledge of iron condors or risk reversals or the myriad of other option strategies, you'll have the opportunity to exponentially increase the profit potential of your options trades, something that prop traders love to exploit when the right opportunity presents itself.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.